Alrighty, folks, I want to have an honest discussion about the potential for inflation 2.0. Yes, the dreaded return of inflation. If you are paying attention to some of the economic surveys, if you're paying attention to the stock market, you are seeing what is often called the Trump pump. What is going on? People are expecting there to be some deregulation, some tax cuts, just basically a improving economy. I fear that if too much of that happens too soon, too fast, that we could once again see the return of inflation. Now, I am not talking a return to 9%, but shoot, a return to 4% would be very, very unwelcome. And folks, I'm going to have this conversation with the one and only Anna Kelly. How you doing, Anna?
I'm doing great. Good to be here.
So I have some economic numbers that I just got today. They're the first survey post-election, the small business survey. And first and foremost, the top line number increased more than expected. It went to 101 from 94. But when you break it down and even go deeper inside the numbers, small businesses increase. They're going to increase employment +3. They're going to increase capital outlays +6. They're going to increase inventories +3. Expect the economy to improve +41. Expect sales to grow +18. Say now is a good time to expand +8. These are impressive numbers for a simple 1 month change, and really could lead to, a very interesting economy in the first half. What do you think?
Yeah, I'm still really just sitting and watching, and I'm listening to a lot of economists and a lot of data, like you and I always do. And the thoughts of where we might go are really all over the place, even by the experts. And I really think that 2025 and maybe even into 2026, we're not going to see a whole lot of change in terms of the real numbers, because these policies take time to implement. The exception to that is going to be, in my estimation, if Trump can get, Congress to extend the Trump tax cuts, we can go back to some lower corporate rates. We get bonus depreciation again, at a higher percentage, because we're down to like 60%. I think it's supposed to go to 40. That comes back to 100. Those kind of tax cuts, businesses will feel an immediate relief because it's money back in their pocket. And then it's optimism for them that, okay, if I'm saving so much on taxes, then I can spend some more money on growing our business, maybe hiring some more people. So I think some of this optimism is the fact that they're hoping to get more tax cuts. But if the tax cut plan stays the way it is, it's basically more status quo. It's not as big of a cut as maybe some people are hoping for. But it's also not a big increase, which they were expecting if we had had a Kamala Harris presidency. And so I think the taxation is really where most of the excitement is. And I think it's the future building of the Build Back Better type of plan. That's in place. Trump wants more of that, along with the reshoring, and that is putting money into infrastructure, into roads. Those things create jobs, Michael, right? So we have semiconductors, we have pharmaceuticals that Trump wants to bring back on shore. Something like 70 to 80% of the components of drugs we need are made in China. And so just the components themselves, those are things that once we bring them on should reduce prices and create some deflation in the future. But the cost to do all of that is very expensive, and it's inflationary. And so depending on the economists that you listen to, though, Michael, and some are, the older economists tend to be more conservative. The younger government economists, out of 700 and something, I forget the number this morning, like 80 to 90% of them are modern monetary theorists. So they're more liberal in terms of their interpretation of the data. So you have to know who you're looking at. But I tend to think, people are going to hit me for this, but I tend to think we're going to have what we kind of have feared for a while, is more stagflation. We're going to have some increases in inflation. We will have some more increase in GDP if the tax cuts and things of that nature and the new hiring get companies to go spend, and people don't get laid off, then they will spend. So that's going to create more GDP. The question is, where will GDP be relative to the increase in inflation? And that's what we really don't know. I don't see anything in the next year and a half. Let's just face it. If Trump got in and both sides of Congress started passing things, they usually go after tax rules first. But these things, even if they're passed in 2025, they're just getting started in 2026. So I'm not afraid of the big hairy monster that we're going to have mass inflation in 2025 and 2026. I think it's going to take a couple of years to start seeing some inflation because of all these Build Back Better and deglobalization, but countered by, you know, some increase in production, some reduction in taxes that could keep us, you know, once a recession, I still think is going to be declared. If it is, or if it isn't, once it's done, I think you're going to have kind of a stagnating economy, other than a couple of sectors that are really going to have money thrown at it. Because the other thing is, Michael, and then we'll, you know, land it there, but we still have 70% of American households living check to check. So you have to have something that stimulates their ability to spend more money on discretionary stuff. And I don't see most of these things that are coming in unless the American people get big tax cuts or big money in their pockets, which isn't going to happen unless we have a, you know, big recession that makes the helicopter money come out. I think the vast majority of the American people, 70%, don't have anything left for discretionary spending. So where does that come from to give us a +4 increase in GDP? I don't see it. I hope we have it. I just don't see the thing that's going to stimulate that much the American households take-home pay that they're going to go spend in droves. I think it's more of the same. The top 20% keep spending money. The businesses keep spending money. And the rest of the American people are kind of status quo.
Yeah, it's going to be interesting because, again, I think, I mean, there are a lot. I mean, if you look at what's potential, you know, possible inside, you know, 18 months of Trump's inauguration. I mean, you could really tie yourselves in knots and create some really crazy boogeymen for inflation. Right. I'll just throw a couple out there that people have thrown at me. What immigration, right? What happens if, I'm just going to pick a number, you know, 1 million people from farming and construction and, you know, other industries where that labor resides today and is productive today. What happens if those people are gone? Well, that work still needs to get done. That food needs to still be picked. So what happens there? Wages go up. You just got to pay more, right?
Right.
That's how that gets solved. You know, we could think about tariffs, right? Tariffs done as a blunt instrument is inflationary, right? And if you go and you start taxing all the BRICS nations, or you know, just focus on China or Europe or Canada, Mexico, I mean, whatever, that could be inflationary. Now, again, I think long term, you know, we start making more stuff here, but there's certainly a window where short-term pain comes. And then lastly, we'll talk about, you know, the taxes. You know, there's a lot of things that could really goose spending. And you're right. It won't be by the bottom 50 or 60%, but, you know, the top 40, 30, you know, if they suddenly saw a 10 or 15% windfall, they've proven to spend and carry the economy before it. So,
right.
I mean,
right.
It's
very complicated. Thing. You know, I thought I understand. I thought I really, you know, understood, you know, at a high level, exactly what you're saying. Okay, we lose, you know, however many million people, you know, actually get deported. That opens up jobs. And, you know, if Americans come in and want those wages, they may demand higher pay. And so that is definitely, you know, inflationary on whatever those products are. But if you look at things like tariffs, you know, I've heard different economists talk about it. And I listened to a guy, Laffer, who has been, you know, a financial economist and advisor to multiple presidents across both parties. And, you know, he says tariffs are really not that inflationary as people think they are, because we go after specific tariffs of things that we basically force the other countries and their manufacturers to absorb things that, it's not like food and things that most of the American people are spending money on. So they go after specific tariffs that specifically are not that inflationary on the stuff that we use day to day. And, they use it as a political tool and a financial tool to do what they want to do. But that over time, the difference in the deflation of costs of other things that don't have tariffs, kind of compensate for the increase that the tariffs have. And so listening to the economists who have worked with tariffs and say this is how it works, they say it absolutely is not inflationary like everybody's afraid that it is. So I haven't had a chance to really dig in to prove what they're saying, but they're guys that have been doing it for a really long time who have, written rules on tariffs before. So I just don't have enough knowledge on that to really know that I have an intelligent opinion on it, but I'm not that worried that the tariffs are as inflationary as, the news piece is going to say that it is before the election. So I think you have some deflationary forces along with some inflationary forces. I'm really more worried about the cost of all of this stuff and what it does to the US debt. And so the question for me is, again, as a real estate investor, is, where are long-term treasury rates going to be? What's that going to do to the 30-year fixed mortgage? And absolutely all the spending that we're going to do. And it would have been the same with both parties, quite frankly, because they are very bipartisan, despite all the rhetoric when it comes to reshoring things for national security purposes, as well as, boosting the economy. It's a lot of spending. And so the first several years before you get the increase in GDP created by all the new jobs and all the new spending and the reduction in costs by having things here, it's going to be somewhat inflationary, but the bigger thing is it's going to grow the debt. So it remains to be seen. I was a little excited that we have a Doge. I thought this is actually really cool that we finally have billionaire business people coming in and trying to cut pork and spending. How successful they are and how much they can cut in comparison to how much we grow the US debt, that's really what I'm looking at, Michael, because it's those long-term bettors that say, where are things going to be? That's really going to impact our interest rates. And if interest rates stay high, that is going to be a pull on GDP, because what we've seen in the past, and I don't hear anyone talking about this, but when I study history, you start to get some tax cuts. And generally, the reason that Republican Party tries to cut taxes at the corporate level is they believe in trickle down, right? If we cut the corporation's expenses, they're going to invest in the future and they're going to invest in employees, and that's going to put a boost in the economy. And in the past, they've actually been quite successful to do that, except when interest rates fell. And when interest rates fell, what did corporations do, Michael? They did not invest in the future. They did not invest in wages. They invested in corporate stock buybacks because the stock markets went nuts. And when you have a change in an administration that makes businesses excited and consumers excited, and they don't know the data and how to look at this economic stuff, what happens enough? Exactly what we saw. We saw the stock market boom. We saw Bitcoin go crazy. Everyone's excited again. It's like the FOMO is over. And as long as that continues and we don't have a big recession and a lot of corporate layoffs, which we may not have declared now, right? Corporations, it remains to be seen whether they actually invest in growth or whether they invest in greed. And as American capitalists, we have seen that corporations invest in greed. So I just am I'm old enough and have been around enough and have done enough research enough that I'm a little skeptical of extreme optimism, like the change in administration is exactly what's going to make us boom. It doesn't actually always work that way. So it remains to be seen, how much economic growth is really generated just because we have tax cuts that benefit the corporate world. I just don't know. I don't know. Yeah. So I'm kind of planning for a stagnating economy, more of the same of what we see today over the next year or two, with pockets of the economy that are going to struggle, that aren't getting the tax benefits and that aren't getting the incentives of all the deglobalization, and with pockets that are going to do really, really well. And we've got to watch what happens and, as it unfolds, because nobody really knows what's going to happen.
Yeah. I actually want to I haven't had this conversation with any of my millionaires yet. I just want to play with this new department, Doge, right? Department of Government Efficiency, I think it is.
Mhm.
It's really interesting. I mean, I remember my college days talking about, $1,000 toilets and, just
Yeah.
crazy things that the government was spending money on. And, that was decades ago. And to hear some of the reports that are already coming out, even before they get in about the waste in pork and fraud or whatever it is, I'm encouraged by what's going to happen in Doge. Right, sunlight is a great disinfectant, and
Yes.
I think a lot of stuff's going to come to light. They're talking about like the Department of Education just getting rid of it. It's like, wow. I mean, it's going to be wild to see what those guys can do.
Absolutely. And, I still don't know how I feel about Department of Education. I mean, we have a huge education problem in our country. I mean, we've spent so much money and we're not getting better results. Our
Yeah.
results are worse than many economies that spend a whole lot less than ours. And so there's a lot of, there's teachers lobbies and things like that. But I can tell you, as someone who's been on school boards as well for, 8 of the last 10 years, teachers are underpaid, so it's not being wasted on teachers, but our entire system has so much waste that we're not effectively. I think we've tried to push a lot of things that don't really, benefit students today in the world that we live in today. And there's changes that are needed. So I think some of it was politicization. I don't think they're going to get rid of the Department of Education fully. I mean, there's so much money that schools depend on from government grants at that level that it would take years and years and years to stop it and the states to come up with a plan to do it. So I think that they're going to continue the department, but probably pull away a lot of programs that, for lack of a better word, are not helping our students. I'm not going to get political at all, but there's a lot of politicization of the education system. And I think they're going to try to pull back some of that. But I saw the Pentagon number and it's early. I had a late flight. My brain isn't fully on fire. I don't remember the number. I think was it $1 billion they lost in their audit that they couldn't find?
Oh, it was worse. It was worse than that. It was like 6.7 billion.
Whoa.
It's
That's
like,
a big number.
Sorry.
You failed again. I think it was like the third year the Pentagon failed an audit, that they're just missing billions of dollars. So, when they come out and they say these kind of things are unacceptable, let's go in, these executives who've run very, very big businesses, I think they're going to have pretty free reign to say, this is stuff, like you said, the $1,000 toilet, the $1,000, nice chair or piece of art, like those kind of things are going to get cut. And I think Congress is going to be really, really nervous because the fact of the matter is, no matter what party you sit on, they come in without any money and they all leave millionaires. I shouldn't say all, that's a big word, but the vast majority leave millionaires because they get incentives and perks and all kinds of things to vote for all kinds of things. And so I think as much as they can do without congressional approval, as much as they can get away with cutting, I think they're going to go after. I think Trump only gave them 1.5 years to say, this is where we need to cut. So I'm excited to see what they come up with. It's needed. And it hasn't been done because senators and congressmen are incentivized for the pork and they're bought. They just are. Ex-senators that have left have said, couldn't stay in the system if I can't be bought, So I'm excited about that. We need that shakeup. And it doesn't matter if you're Democrat or Republican. $6 billion of waste is money coming out of our tax pockets that we're paying for. And so all Americans should cheer, whether you like the guys or not, whether you like Trump or not, all Americans should cheer. Hey, they want to come and they want to audit us. The IRS audits the little guy who's, barely making money. It's about time that they audit the US government and start cutting expenses. So I hope that they cut a lot. I hope that light, like you said, shines in those dark places that says, this stuff has to go. And I am conservative fiscally. And so I do think that it's really important to have smaller government, not government involved in so much stuff. Because the reality is, and this is proven over and over again, no matter what party is in power on both sides, when government takes over something, they're far less efficient financially than the private sector is. And so there are certain things, of course, national security and, taking care of our veterans and taking care of homeless and the widows and the poor. Money needs to go into there. Government needs to do that. But when you say, hey, here's a pet issue, and you've got a small percentage of the population that this impacts, let's now take it over, create all these laws. It costs the taxpayers millions and millions and billions of dollars of money that never flows through to really provide very much benefit. So I'm excited to see them cut government size, cut government spending, put a little bit of money back into the American people, and then privatize some of those things that can create more efficient movement of money and will create and stimulate higher GDP. I know it's easier said than done, as an armchair quarterback, but than it is, in reality. But I have hope for the first time in many different presidents and Congress that they're actually going to say, okay, the American economy is not sustainable. We've got to make some changes. And that includes making big changes at the government and cutting government waste.
Yeah, I mean, we've really got to take a hatchet. This government debt. I think it's up. I don't know. I think it goes up like $1 trillion every 90 days or something, just insane.
Yeah.
It's going to be very interesting to see what these what can get done. And you're right, it's got to get done before the midterm elections, right? I think it is an 18-month clock or 20-month clock on it, so it's not going to be around for a long time. The last thing they're going to do is get rid of themselves, which I think is pretty cool. I want to talk about the Fed meeting next week, and I want to reference Yardeni Research because I think they put out a piece that I agree with entirely. So here we go. 2 steps. Step 1, the Fed will cut 25 basis points and then be very, very hawkish. So they're going to talk tough in front of the microphone, in speeches, yada, yada, yada. Part 2, Yardeni Research, excuse me. They should pause and wait to see how the economy reacts to the 75 basis points, that new administration. They should keep the 25 in reserve. So again, this is what the Fed will do, cut 25, but this is what they think the Fed should do, is pause. And I got to tell you, I'm in that camp.
I'm probably not, but I like when we disagree.
Me too.
I do think they're going to cut 25. I don't think that they're going to pause. So I would be shocked if they actually pause. I really would be. And again, I know, what the headlines are saying, and I know we just created some jobs, but when you look at the details of job creation, you look at the details of GDP, and you look at the details of where we had increases in CPI, we still have a lot of pressure on employment. I know we're not at the worrisome 4%. And I know that corporations are somewhat more optimistic, as well as some small businesses. So the fact that there is more optimism might keep some of those businesses from going through with their January layoffs and their December layoffs as they had planned. But when you looked at corporate surveys before, just a couple of months ago, many were planning layoffs in December and January because they just can't keep it sustainable. And there is a lot of corporate debt that was refinanced for 2 years, but it's been 2 years and rates are still high. So there's actually more corporate bankruptcies and small business closures than any time since right around 2009 and 2010. And we still have some layoff plans. So I'm not as optimistic that suddenly none of these corporations are going to lay off, that suddenly everything's just going to go from here, that we're not going to have more layoffs, that we're not going to have softening, that we're not going to have some layoffs and an increase in unemployment. If we don't, that would be great. Obviously I would be cheering that, but I still think Powell's worried enough about, the on the ground beige book type surveys that are saying there's still a lot of pressure in construction and housing and in manufacturing. Those are the 2 sectors of the economy that historically have really driven GDP. And when you have housing and manufacturing still in a recession, we haven't even started to see the real pressure and layoffs of construction workers. It's just starting to happen. So the question again is, if those sectors start to struggle more, because let's say, we're putting all this money into all these projects and that's going to be inflationary in the short term and it's going to keep the treasury markets up, Michael, that keeps interest rates up. So no matter what's happening, and we have a little more money, we have a little more inflation, we're spending more money, what's happening on the other side? How stimulative is it? And if people want to go buy houses and redo their homes, and they want to, put money into manufacturing, that costs money, right? And so I just think that there's still enough employment risk that they still have to look at that about equally as they do inflation in the short term. And this particular Fed, they're looking at the data from last month. They're not setting rates based on what they see in the future, which is what they're supposed to kind of do. They're supposed to be ahead of us. They're reacting to real-time data. I don't like the way they're doing it. But real-time data has a lag of about a year, 18 months. And so the data we're looking at today is reflective of where interest rates were a year and a half ago. So you can have optimism, but that's not going to trickle into real impact on the economy till, early 2026 to mid 2026. The Fed knows this, right? So I don't think they're going to be as hawkish as maybe the piece says that they're going to be, or that they're going to be as tough on that, because they still have the reality that these things are expensive. Interest rates could stay higher. That's going to put a balancing effect to the optimism on corporate refinances, commercial real estate, housing, and all the jobs impacted by that I think it's going to be about a balanced risk as it was before. Now, I do think if there's balanced risk, the answer is you keep interest rates where they are, unless somehow Congress and the president say we have to get our cost of the interest on the debt down, and therefore we need to put pressure on the Fed to cut interest rates because of its impact on the government and the cost of servicing that debt, and them wanting the U.S. Treasury to go down so that corporations and the American people can stimulate manufacturing and housing again. And so, we just can't lose sight of this data point means they're going to be hawkish. This data point means we're going to have so much inflation, because there are deflationary drags still on the economy, and nobody really knows where that balance of risk is. So I think they should cut 25. I think they should pause and not be hawkish, but I think that they need to watch employment very, very carefully. And if we continue to see a lot of layoffs this month and next month, and I know people personally in different industries who just got laid off, and it's Christmas time, and so it's the holidays. So there's still companies that are laying off, and I'm still nervous about that.
Yeah, again, I'm with you. I think they're going to cut. I think they've telegraphed it. Unless CPI is just nasty surprise next week, that's the only thing that could stop them cutting 25. I do think that there's a better than 50-50 chance that this is their last cut for at least 6 months. I think they're going to have to pause and see how things play out from here. Again, assuming unemployment doesn't, take the elevator to, higher.
Right.
But I think interest rate sensitive areas like real estate and autos are in for a tough year, kind of at the beginning of this conversation. It's going to be higher for longer. You're not going to get the tailwind of 5% mortgages. You're going to struggle with, 7% mortgages. Yeah. And it's just going to be one last tough year if you're paid on transactions. That's what I'm thinking.
Absolutely. And, the other thing about that in terms of small business layoffs, big corporations are more excited than small businesses are, because they haven't had the big corporate tax cuts, and they're excited about, the possibilities and the opportunities, especially if they're in sectors that are going to start getting money. But small businesses, many of them are based on discretionary goods, things that people don't need, but they want, for example, the hair salon, certain gyms, places that do cosmetic surgery, weight loss stuff, all that stuff's expensive. And so again, even if interest rates stayed where they are, a lot of small businesses have loans that are based on the short-term interest rate, and they need lower rates because they're having a refi. And so I've had conversations with people that have loans, and they're kind of in the survive to 25 camp, just like commercial real estate has been. Is like, we're just hoping we can survive till we can refinance some of this debt at lower interest rates. And so I think that you're going to have definitely more small businesses that start to fold if the economy stays kind of status quo because of that 70% living check to check and not having money on its discretionary goods. And if CPI goes up and groceries go up again, people are just going to pull back on discretionary stuff. So small businesses run America, right? We've got the big companies. We talk about the stock market, but the small businesses are the backbone of the economy. And if they start to struggle because interest rates are low and they can't get enough people to come in and buy discretionary stuff, that again is a real risk to the economy. And then the other thing, and we talk about this all the time, but we probably haven't in the last couple of weeks, is the banks. If the Fed doesn't figure out a way to cut interest rates, this means commercial real estate that was pushed for a year or two, and we're hoping we can extend and pretend your loan until rates fall. They're doing the same thing with corporations, with small businesses, and they still have bonds that haven't matured. So I'm still nervous about the impact on the banks and banks having to write off assets that are still, sitting there and hold to maturity. They're going to be forced to start to close on, to foreclose on some of these loans. And that can stimulate a banking crisis, which people just kind of think, oh, we have a Republican Party and they're going to make things, wonderful. And they're going to make, this booming economy. You have to realize that the banks that actually lend money to businesses to stay open and to be stimulated, they're still pencils down, Michael. They're not lending because they can't, because they have too much risk on their books. And if you look at history and you look at the end of the 70s and you look at, Reagan coming in, and in fact, Laffer, the guy that I mentioned, was a Reagan economist that helped put in his plan that created the boom. The savings and loan crisis didn't start really until after that. And so it was this trickle down of 7, 8, 9 years before it was over. And I'm still watching for that. So again, I'm a really optimistic person. I mean, I've made money because I've been optimistic in fearful times and going, okay, where can I make money? What can I do? I'm always saying I can make my economy better no matter what's happening in the world economy or the local economy by decisions that I make. But the reality is we have a lot of, we still have a lot of headwinds against us that can create a lot of economic conditions that can make things harder for longer than what I think people are hoping that it will be. And those are just a few of the things that I'm watching to make myself say, okay, what I kind of feared might happen is these interest rates are going to be higher for longer. My mortgages are going to reset at double the mortgage payment. I have to prepare for a cut in income. I may have to do some buy down of my mortgage, cash in, refi. I think there's a lot of businesses and commercial real estate that are going to be in that position this year, 2025 and early 2026. And that's going to have a real pull on the economy. It's going to force landlords to raise rents. And that's going to have a real downward pull on the discretionary income of people. And that's going to keep people from spending. So I just feel like we need to be prepared for kind of a stagnant economy and not get too much hopium that, oh, everything's booming, so let's go, into a bunch of debt and rah, because it doesn't really work that way.
No, I've been talking about this, the commercial market for quite a while on my channel. And we are seeing Class A start to retrade at 25% off. But I think the real pain, the real write-downs, the real losses are in Class B and Class C because, those assets were never meant to trade at near the cap rates of Class A. And frankly,
agree.
We got so stupid those last couple of years. There were buildings in my area that were trading within whispers of Class A buildings, Class B and Class C.
Absolutely.
And
in tertiary markets outside of the big cities. So, I always pick on Oklahoma City because I know a bunch of people that started investing there. They've historically had a 14% vacancy rate, and there were not new jobs coming in to bring more people, but everybody's like, we'll flip these apartments there because we can buy them cheap. Well, there's a reason that there's cheap. There's not enough people to fill them, So you've got a lot of small town America or outside of the major hubs that, these, people invested in these apartments and now they're, going into foreclosure. They're dilapidated. Nobody wants to live there. Crime is going up, and so there's a real impact on the people that people don't quite realize that it's very broad. It's most of the apartments in the United States are B and C class. So what happens when nobody owns them and the bank owns them? And it really pulls on and drags.
Well, let's just play with an example. Jonathan Twomley and I think a couple of years ago, we very quickly turned $100 million building into sub 50. right? You don't have to. It's not hard. NOI goes down and cap rate goes up a couple of points, and bingo, bango, you've got a a $50 million building instead of 100. But I don't think people really realize who gets hurt in all of that. So let's just play for a minute. There was a building that sold at 100. Let's assume 70% loan, reasonable, Anna.
Yep, absolutely.
So that's 30 million in equity, and we're just going to use round numbers and not transaction costs and all that other stuff and mortgage pay down. So the 2 years is up. The bank gives them an extra 12 months, kind of like, hey, I'm going to look the other way. Let's see if you can get there. They can't get there. The building's probably because again, I've been through this. What happens is the person that's running that building sees the writing on the wall, and they are going to start cutting corners. They're going to start squeezing expenses. They're going to start. They have to. They're going to start band-aiding versus in capital. It's the building's going to go down, and eventually the owner of the note's going to look at the building, which used to be in a B quality. Now it's a C quality because whatever's going on. They're going to be forced to foreclose. And
absolutely.
What happens there is people don't get it. If let's say 100 to 50, the $30 million of LP or equity gone.
Yeah.
Then the bank takes a haircut. In this example, the bank will take a 20% haircut. And then the next owner who picks it up for 50 will probably have to put in at least 40% equity because now the quality is out, and maybe even 50% equity.
Yeah.
To get, let's say 50. So that $50 million building is going to have 25 million in equity and a $25 million loan instead of 70. That the next buyer is going to print money. It's just how the math is going to work.
Right. And it's tough because let's just say across the country, and there are some that have a 50% haircut. Most of them are about 30% in multifamily. But let's say you have the $100 million property, you have a $70 million loan, and let's just say it's worth what the loan is. It's now $70 million property with a $70 million loan that was extended for a year. But when it resets, the rules and in the loan covenants basically say you must maintain a 75% or let's just say 70% LTV, right? So if you've got a $70 million property and a $70 million loan, it's 100% LTV. The rules and the bank regulations say, no, you've got to keep 70%. So now to even refinance that property and not lose it, you're going to have to pay in, quick numbers in my head, 50, you can do a $53 million loan.
You're going to have to put in $21 million.
$21 million, so I'm just going to round it to 20, right? So my $70 million loan, if I want to refi, I get a $50 million loan. I got to cash in 20 million. So I need a capital call.
Ouch.
How many LPs, when they're they've lost their equity, are going to pay in anymore and know that they're going to not have anything on the back end? They're not going to do that. And in fact, I've had capital calls on me as an LP. Most of them I have not paid in. One of them I did. I believe in the property, the location, the operator, very, very much. And so I did, but most aren't paying into the capital call. So then they handed it over. So it's not like these are horrible operators. They just cannot raise enough money because on paper, those buildings are not worth enough. And so, in Class A, the people that historically have bought Class A are these REITs. They're big corporations, and they're buying them because they're sitting on an asset that they can hold in their books. And if they pay cash, they're usually not getting loans on them. They pay cash. And if they're buying, a new property that traded at a 3.5 cap and they're buying it at a 5 cap with cash, they're making a 5% return on their money for their fund. They can't do that with B and C property because they have older buildings that are going to have a lot of problems and a lot of deferred maintenance. So it only works on Class A. The reason they're still trading is because they're paying cash for the buildings that are brand new with a high quality tenant that should weather economic storms. It's going to continue to pay rent, and they're banking on that. And they're still hoping that, interest rates fall and that makes the value of their property go up. It would trade at a lower cap rate. But for the vast majority, and I don't remember the percentage, but the vast majority of apartment buildings are Class C in America. They're 30 years old plus. Some, Class B, 20 years old to the last, 5 years or so, depending on the market. That's where most of the properties are. So they've all been hit by that 30% haircut, with no buyers to come in. Because not only do I, as a buyer, have to make a better return than, I want 2.5% above the US Treasury rate. So I don't want to buy anything that's not at least a 7 cap on a Class B property. But my expenses are much higher than the last buyer. My interest rate is double, but my taxes are higher. My insurance is higher. They still could go higher. But the hard thing is I can't force rents up enough because I'm competing with a lot of Class A properties in those markets that are giving 2 months free to move into a nicer place. And I can't borrow 70% today. As an experienced real estate investor investing for over 25 years, I might, if I'm lucky, get a 60% LTV. So I got to put 40% down. When you put 40% down and you're buying stuff, that's not trading at a 7 cap still, the numbers just don't work. I can't pay my investors 15 to 18% on their money for the risk that they're taking in these type of properties. When I've got to raise 40% of my money plus any capex from investors that want that much, 18%, much less the 8% that I'm going to have to pay to buy it. So it's a really hard time for buyers to buy and be profitable, even though there's sellers that need to sell to not fall. And so the transaction volume is not going to wake up until there's a big decline in value, or
Agreed.
Banks open up and banks start lending on these things and interest rates fall. And right now that's not going to happen. So, I think it's going to be a tough 2 years or so unless we see a big dip in interest rates. The Fed and Treasury backstop the banks and tell them, keep lending, we'll back these mortgages, pump money into the system to get the economy and to unbreak the commercial real estate and the banking sector. And we could see those things. But right now, I think it's going to be tougher than most people hoped over the next 2 years. And so we need to, we need to be wise. We need to make wise purchases. We need to hold cash, hold reserves, and look for a steal. When there's pain, there's huge opportunity, but it's still at this point kind of a needle in the haystack to find it on the commercial side.
Yeah, no, again, the market is simply frozen. Stuff is not retrading, so there's no price discovery.
Yeah.
I think what will happen is there will be some bank, some lending institution that is first to go. And that will be the kind of, the straw that breaks the camel's back, because then it will become a kind of race to the bottom, if you will. So it's coming. I mean, you can't, it has to come. They can delay it.
Yeah.
They can slow it, but it's certainly coming. Anna, where can people find you?
Great. You can find me here every week on your show, just about every week. You can find me on social media at Anna Kelly, REI Mom, and my website for coaching and consulting, deal review, investment review, etc. is AnnaKellyInvesting.com.
Anna, you're amazing. Thank you so much.
Thank you.